In this video, we're going to talk about owner's equity. It's one of the most important concepts for any size business, from small work-at-home freelancers right up to the largest corporations in the world. But because the phrase owner's equity sounds like boring accounting jargon, it's not widely understood. But it is important, and that's because it's one of the best measures of the overall health of a business. You see, for a small, uncomplicated business, owner's equity is calculated by subtracting its total liabilities from its total assets. Yep, that's it. That's all you have to do. If you run a small business, just add up your assets, add up your liabilities, and subtract one from the other. It's as simple as assets minus liabilities equals owner's equity. Pretty easy, right? Well, for small businesses, it is. For larger and more complex businesses, however, working out owner's equity can be more complicated, but the basic principle is still the same. So in this video, we're not going to worry about large, complicated businesses. Instead, we're going to focus on something more relevant to the little people like us, which is how to calculate owner's equity for small businesses. Let's say you run a small online retail business from your garage. You buy inventory from your suppliers and sell it to your customers via an online store. Because you need access to the internet at all times, you decide to buy a laptop as backup in case your computer breaks. When you first started your business, you put $10,000 of your personal money into your business's bank account to buy inventory and the computer. Any money you didn't spend was left in the business's bank account in case you needed it. You also purchased the laptop, but you used a loan to fund the purchase. So let's have a look at how to work out the owner's equity of your business. First, let's calculate the owner's equity at the time you invested $10,000 of your own money to start your business. Let's call this day one. Now bear in mind that at this point in time, the transfer of cash into your business's bank account is the only transaction that has occurred. You have not yet used the money to buy inventory or the computer, nor have you taken out the loan to purchase the laptop. So what you have on day one is an asset of $10,000, which is the cash in the business's bank account, no other assets, and no liabilities. Using our formula of assets minus liabilities equals owner's equity, we get $10,000 minus $0 equals $10,000. So, on day one, your owner's equity is exactly $10,000. Let's say that the very next day you purchased $5,000 worth of inventory and spent $2,000 to buy your computer. Because you used some of the $10,000 cash in the business bank account for these purchases, you're left with $3,000 in the account. So, on day two, you have an asset of $3,000, which is the cash remaining in the business bank account, an asset of $5,000, which is the inventory you purchased, and an asset of $2,000, which is the computer you purchased, and no liabilities. This means you have total assets of $10,000 and total liabilities of $0. Using our formula of assets minus liabilities equals owner's equity, we get $10,000 minus $0 equals $10,000. So, on day two, your owner's equity is once again exactly $10,000. Now, before we go any further, you've probably noticed something that we haven't discussed yet, and that is that owner's equity is something that is calculated at a chosen point in time. So far, we've worked out your owner's equity on day one and day two of your business. Well, if we want to, we can calculate your owner's equity at any point in time by simply comparing your assets to your liabilities at that time. But despite the fact we're doing it this way for the video, it's not normal practice to calculate your owner's equity every day. Instead, it's customary for small businesses to work out owner's equity once a year, usually at the end of the financial year, and for large businesses to do it at the end of each month or quarter. Okay, let's finish off our exercise now. We still have one more transaction to go, and that is to take out a loan and buy a laptop with the funds. Let's say that the laptop costs $1,000 and the loan is for $1,000 plus interest of $200. This means that you're buying a $1,000 laptop, but you need to repay $1,200 to the bank over time. What this means is that you're adding an asset to your business of $1,000 and a liability to your business of $1,200. Assuming you do this on day 3, what you now have is an asset of $3,000, which is the cash remaining in the bank account, an asset of $5,000, which is the inventory you purchased, an asset of $2,000, which is the computer you purchased, an asset of $1,000, which is the laptop, and a liability of $1,200, which is the loan, including interest, for the laptop. This means you have total assets of $11,000 and total liabilities of $1,200. Using our formula of assets minus liabilities equals owner's equity, we get $11,000 minus $1,200 equals $9,800. So, on day 3, your owner's equity is $9,800. So there you have it, a simple example of how to work out owner's equity for a small business. Obviously, as the business starts selling products to customers, buys more stock, and possibly buys more assets or hires staff, the business will get more complicated, but the basic principle of calculating its owner's equity at any point in time will be the same. So that's the basics of how to calculate owner's equity. But before you go, there's one more thing we need to discuss. You may have noticed that your owner's equity went from $10,000 down to $9,800 after you took out the loan to buy the laptop. While you now know how to calculate owner's equity, you may be wondering why this reduction in owner's equity is important. Remember at the start of the video how we mentioned that owner's equity is one of the best ways to measure the health of a business? Well, in this example, owner's equity has decreased by $200 because of the need to repay the interest on the loan. What this means is that the business is less financially healthy than it was before taking out the loan. In fact, it is exactly $200 less healthy. Now, a $200 reduction in the financial health of your business isn't too bad, but what if the loan required you to pay $1,500 of interest over time? This means that you would have to repay $2,500 in total in order to buy a $1,000 laptop. This also means that your owner's equity would reduce by $1,500 instead of just $200. So, in a nutshell, the more interest that needs to be repaid on the loan, the bigger the reduction in owner's equity and the less healthy the business becomes. This is a good example of how owner's equity can be used as a way of doing a quick financial health check for a business. As you can see, calculating owner's equity for a small, uncomplicated business is fairly easy to do, and if you compare your current owner's equity number with previous numbers, you can quickly see whether the health of your business is getting better or worse.